All right, let's dive right into a classic financial mystery. We are going to crack the code on cash flow, one of the most important ideas in all of accounting. And to do it, we're basically going to become financial detectives, following the clues to uncover the real story.
So, here's the central puzzle, the big question. You see a company report record profits. They're all over the news. But then, a few months down the line, you hear they're having trouble paying their bills. How in the world is that possible? It sounds crazy, but it happens all the time, and it's exactly the paradox we're here to solve today.
You see, to get to the bottom of this, you have to understand that there's a difference between the story a company tells and the reality of its bank account. Net income, that's the profit number. It's the story. It's crafted with accounting rules, estimates, all that stuff. But cash flow, that's the cold, hard reality. It's the actual cash moving in and out. Our job is to bridge that gap between the story and the reality.
And the tool we're going to use for this investigation is called the Indirect method. Now that name might sound a little intimidating, but it's the most common way companies do this. And the idea is actually really simple. We start with the company's reported profit, and then we work our way backward, adjusting it step by step until we find the real cash number.
Think of net income as our prime suspect. It's our starting point, our first lead, but we know it's not telling us the whole truth. So our job is to put this number on the stand, to interrogate it and find all the places where it's hiding or maybe even distorting the real cash story.
Okay, so our first set of clues, we're looking for something called non-cash items. These are expenses that got subtracted to get to that shiny net income number. But, and this is the key part, no cash actually left the company's bank account because of them. Let's go find some evidence.
And the most famous of these non-cash items, the absolute all-star, is depreciation. Think of it this way. A company buys a huge machine for, say, $1 million. They don't just write off that $1 million in 1 year. Nope. They spread that cost out over however many years they expect to use the machine. And that yearly expense is called depreciation, and it reduces their reported profit. This leads us to the most important question you can ask for any of these items. For this year's depreciation expense, did the company actually write a check to somebody? And the answer is nope, not a dime. The cash went out the door years ago when they first bought the machine. This year's expense is purely an accounting thing.
And that right there is the logic for our very first adjustment. Since net income got pushed down by this expense that wasn't real cash, what do? We have to add the full amount of that depreciation right back in. We're just reversing the accounting entry to get one step closer to cash reality.
All right, first clue in the bag. Next up, we have to deal with what I call the outsiders. These are gains and losses that got mixed into our net income number, but they have absolutely nothing to do with the company's core, day-to-day business operations. You know, think about a bakery. Its main job is selling bread and cakes. But what if it sells an old delivery van? Or maybe a software company sells some stock it owned as an investment. The profit or loss from those sales gets lumped into net income, but that's not cash from its main business, right? It's from an investing activity.
And that's the question we've got to ask. Sure, that big gain from selling an old factory might make the profit number look awesome, but is that something that's going to happen again next year? Is it a true sign that the core business is booming? No, it's a one-off. For our investigation into operating cash flow, we have to pull it out.
So here's how we clean up the evidence. That gain made our net income look bigger than it should from operations, so we subtract it out. And it works the other way too. If there had been a loss from selling that equipment, well, that would have dragged down net income, so we'd have to add it back. We're just isolating the true operational story.
Okay, now we get to what is probably the trickiest, but honestly the most important part of this whole investigation, timing differences. This is all about the gap between when a company records a sale and when the cash actually hits its bank account.
And this right here, this is our secret weapon. This is our detective's decoder ring. It gives us the simple rules for all those operating assets and liabilities. You know, things like inventory or money customers owe you. Just look at the pattern here. An operating asset goes up, we subtract from net income. A liability goes up, we add. Let's actually put it to work and see how it goes.
All right, first case file, accounts receivable. This is just the fancy term for money your customers still owe you. The balance sheet tells us this account went up this year. So what does that actually mean in the real world?
Well, it means the company made a lot of sales on credit. That looks great on the income statement, right? Revenue goes up, profit goes up. But the cash? It hasn't been collected yet. It's basically a big pile of IOUs. The story of profit is way ahead of the reality of cash.
So what do? We just pull out our decoder ring. An increase in an operating asset, which accounts receivable is, means we have to subtract that increase from net income. Simple as that. We're just correcting for the cash that hasn't shown up yet.
Okay, let's do another one. Inventory. The balance sheet says the inventory account also went up. What's the story there? Well, it means the company spent cash to buy more stuff, raw materials, finished goods, than it actually sold.
And the rule is exactly the same. An increase in an asset, in this case inventory, means cash went out the door to pay for it. So we subtract that increase from net income to show that cash is gone. You're starting to see the pattern, right?
And just like that, we followed all the big clues. We started with our prime suspect, net income. We adjusted for all those non-cash expenses. We kicked out the non-operating outsiders, and we fixed all those tricky timing differences. I'd say, case closed.
So here it is, your final report. Think of this as your investigation checklist for any cash flow statement you look at from now on. It's always these 5 steps. Start with net income. Add back stuff like depreciation. Then subtract the gains and add back the losses. And finally, use that decoder ring for changes in assets and liabilities. That's really the whole indirect method right there. Oh, and before we wrap this up, here's a little pro tip for you, straight from the chief inspector's desk. Sometimes on an exam or on a problem, they won't just give you the net income number. They'll make you work for it. But here's the trick. Just look at how retained earnings changed. Add back any dividends that were paid out, and voila, that's your net income. Super handy little trick to keep in your back pocket.
So there you have it. You now have the tools. You know how to look right past that flashy headline profit number and find out what's really going on with a company's cash. You can tell the difference between a company that's just good at telling a story and one that actually has the cash to back it up. So my question for you is, what other financial mysteries are you going to solve next?